The entire artificial intelligence investment universe is holding its breath right now, and the tremors you're feeling in your portfolio today are just the beginning of something much larger. AI chip stocks across the board are sliding in today's trading session, and the timing is anything but coincidental. This sell-off is happening directly ahead of Nvidia's upcoming earnings report, arguably the single most anticipated financial disclosure in the entire technology sector right now. And what makes this moment so fascinating, so deeply worth examining, is that it reveals something profound about how modern markets process fear, expectation, and the psychology of extraordinary success. Let's think about what's actually happening here. Nvidia has become more than a company, it's become a barometer, a thermometer, and frankly a mirror for the entire AI revolution. When Nvidia reports earnings, it doesn't just tell us how one company is performing. It tells us whether hyperscalers like Microsoft, Google, and Amazon are actually deploying the capital they've promised. It tells us whether the trillion-dollar AI infrastructure build-out is real spending or aspirational forecasting. And right now, investors are not willing to sit exposed while that verdict is delivered. The stocks dipping around Nvidia aren't doing so because there's suddenly bad news about AI. There's no scandal here, no regulatory bombshell that dropped overnight. What you're witnessing is something more nuanced. It's called risk reduction ahead of a binary event. When one company's earnings report has the power to move entire sectors by double-digit percentages in a single session, sophisticated investors don't gamble with open positions. They trim. They hedge. They wait. And that's precisely what makes Nvidia's position in this market so extraordinary and so strange. A single quarterly earnings call from one company in Santa Clara, California can send shockwaves through AMD, Broadcom, Marvell Technology, TSMC, ASML, and a constellation of smaller chip designers all at once. That level of gravitational influence over an entire sector is historically rare. You'd have to go back to the peak dominance of companies like Intel in the 1990s to find anything remotely comparable, and even that analogy falls short of capturing Nvidia's current market position. Now here's where the analysis gets genuinely interesting. The question investors should be wrestling with isn't simply whether Nvidia beats earnings estimates. At this point, beating estimates is almost the baseline expectation. The real question is whether the guidance Nvidia provides for future quarters satisfies a market that has already priced in near perfection. If Nvidia delivers exceptional results but offers conservative forward guidance or even guidance that's merely good rather than extraordinary, the reaction could be severe. The stock slipping today might be telling us that the market is quietly acknowledging this asymmetric risk. There's also the supply chain narrative threading through all of this. Nvidia's Blackwell architecture chips remain in extraordinarily tight supply, and demand from major cloud providers appears insatiable. But insatiable demand running into constrained supply creates its own complications: revenue recognition timing, customer concentration risk, geopolitical exposure through Taiwan-based manufacturing. These aren't abstract concerns. They're the variables that analysts will be dissecting line by line when those earnings drop. The broader AI chip ecosystem, companies that supply memory, networking components, advanced packaging, and software stacks, they're all tied to the same demand signal that Nvidia will either confirm or complicate in the coming days. This isn't just about one company's revenue number. It's about whether the foundational investment thesis of our current technological era remains intact. So as these stocks quietly bleed heading into that report, ask yourself this: in a world where one earnings call can validate or vaporize hundreds of billions in market value, have we built an AI economy that's genuinely resilient? Or have we simply built a very sophisticated house of cards balanced on a single chip?